Hello and welcome to the Mint Fund and Market Update. My name is Ryan Falls and I'll take you through what's happened in markets over the previous month and how our diversified funds did. Starting off then with equities, so we had a bit of a soggy summer for AI stocks. So the dominant AI theme in markets has lost some ground as several companies released less than positive news during July. So what we have here is a chart of the S&P 500 index versus the S&P 500 information technology sector by itself. And as you can see, the information tech, which is we're using here as a proxy for AI theme in markets, performed quite strongly at the start of the month, outperforming the S&P as a whole. However, as we move through the month and towards the end of the month, we can see that it actually underperformed quite significantly to the S&P index as a whole, with the relative return being down 3% against the overall index. So we had a few companies release less than positive news, and they were namely Microsoft, which had a small miss on earnings. We also had Intel announcing some 20% cut to its workforce globally. And then finally, we had NVIDIA just at the very end of the month announcing that there was going to be a delay on the production and delivery of some of their AI chips. So taking in consecutive news, this actually had the effect of quite amount of negative sentiment based around AI companies and anyone loosely related to AI theme. Moving on then to some other volatile markets, and these are the geopolitical markets. So we had a very volatile month in the US election cycle. We had people pricing in the Trump trade, and then Biden stepped down and turned things on its head. Quite a few events happened during July. So looking at our chart here on the left, we have the red line represents the implied probability of a Trump presidency, and the light blue line representing the implied probability of a Harris presidency. So we have here on the line on the 15th, we can see there was a Trump assassination attempt, which was unsuccessful. And you can see here that there's a small bump in sentiment for Trump around that date. And then also on the 21st of July, Joe Biden announced he was stepping down from the election race, and he effectively handed the reins to his current incumbent VP, Kamala Harris, which then obviously gave her quite a boost in implied probability of entering the White House after the election. The key thing to note here from markets is that as the geopolitical scene unfolds and outcomes become less clear or less certain, implied volatility or realized volatility within markets tends to increase. So we have that light green line here, which is the VIX index, which is a market indicator for volatility. And as you can see, it's going to the trending up and to the right as implied vol has increased as the outcome of the election becomes less certain. What this means is that markets were more likely to whipsaw on little information and will rapidly price and not price in different outcomes depending on what the odds are for either candidate. Turning now to New Zealand. So we had a perceived dovish hold at the RBN's July meeting. Hold insofar as the OCR did not change, but dovish in respect of the wording of the statement of the meeting. So what this led to was the market's view on the timing and the number of cuts being brought forward, and this sparked a very strong rally in domestic fixed income as yields fell. So what this chart here shows is the market pricing based on the OIS curve at the end of June and the end of July for the light blue and the red line respectively. And then we also have the RBNZ OCR tracked from their previous meeting in May. So as you can see, quite a significant drop in market pricing for where people see the OCR ending up. And if we look towards the June 25, we can see effectively there is 75 basis points difference between the light blue line and the red line, telling us there's going to be effectively 3 more cuts by June 25, based on market's view of where interest rates are going. We should also flag within July that we had CPI released in New Zealand. It was a small beat on headline, so it was 3.3% versus 3.6%, and this is for Q2 24. However, there was some things underneath the hood which some dovish and some hawkish people were happy with. So the hawkish market participants were buoyed by the fact that non-tradables inflation was a slight beat at 5.4% versus 5.3%. However, the tradables inflation was quite a downside miss, and that actually helped bring down the overall headline figure down to below what RBNZ and other market participants had forecast. Turning now to the diversified funds, and we'll start with the diversified income fund, which had quite a strong month last month. So it was up plus 3%. Asset class performance was positive across the board in July, as global equities had a strong start but slightly weaker end of the month, and the domestic rates environment was very accommodative for fixed income. So as a function of that, fixed income was our largest positive contribution, so plus 1.9%, with Australasian equities up plus 0.9%, and then finally global equities came in at plus 0.1% for July. So jumping on the fixed income part, so they obviously bonds performed quite robustly as rates drifted down post that July RBNZ meeting. Markets, as I say, broadly interpreted it as a dovish pivot. So our long duration positioning helped bolster our returns as interest rates fell during the month. Within global equities, we had Roche Holdings was up plus 14.6%. And Thermo Fisher Scientific Incorporated was up 10.9%. So they're the top two contributors within global equities. Roche was buoyed on news that their new weight loss pill achieved positive results in its early stage clinical trial. Turning to the Australasian equities, so we had main freight was up 10.2%, and that surged on shipping and freight costs increasing in the face of rising political tension, both in the Middle East and the Red Sea. Turning to the negative contributors for the portfolio, so within global equities, we had Novo Nordisk was down 9.3%, and Charles Schwab was down 11.5%, and they were our top two negative contributors. So Charles Schwab was down on disappointing earnings release during July, in which they stated the Q2 sales rose less than market expectations, and that their net interest revenue declined year on year. Within Australasian equities, Contact Energy was the most negative contributor, so it was down 5.6%, and that sagged after releasing disappointing results at the beginning of July, in which their 2025 EBITDA and dividend guidance was below market expectations. Turning now to the Diversified Growth Fund, so we also had a positive month of July, so the fund was up plus 1.9%. Australasian equities were the top contributor, plus 0.9%. Global equities was next, contributing plus 0.6%. And then finally, we had fixed income, again, up 0.4%. Turning to the positive contributors for the growth fund, we had Roche Holdings, again, up 14.6%. Thermo Fisher Scientific, up 10.9%. And again, Roche was buoyed in that news with their weight loss pill, achieving positive results in the early stage clinical trials. Within Australasian equities, we had Skellerup Holdings up 18.4% and Somerset Holdings up 17.9%, and they were their top two contributors. Somerset bounced on a general sector re-rating after some merger activity within the sector, and then also lower interest rates helping valuations of their assets. And again, we want to just drag attention to the fixed income performing robustly as rates drifted down, so we had a strong positive contribution there, and our long duration position also helped the growth fund overall return. Turning to the negative contributors within global equities, again, Novo Nordisk was down 9.3%, Charles Schwab was down 11.5%. And I guess turning to Novo Nordisk, so it slid on news that Roche, one of our positive contributors, had positive results from their clinical trial, and then investors effectively priced in a potential loss in market share from Novo Nordisk within the weight loss pill sector. And then domestically within Australasian equities, we had NextDC was down 5%, and that struggled on concerns towards the end of the month that the dominant AI theme in markets was running out of steam. So as I mentioned previously, we had a few consecutive negative news items for some of the big players, which meant that markets priced in that the demand for NextDC's data center capacity may wane relative to previous expectations. And that's all for the month of July. So thanks, everyone. If you have any questions or any concerns, please feel free to send them all to info@mintasset.co.nz. Thanks.